In Chapter 1, we are going to look at some basic concepts of accounting, which are going to create a foundation for the rest of the course. We are going to look at different types and forms of businesses and understand the role played by accounting in a business. We will define generally accepted accounting principles. We will also take a look at some important terms: assets, liabilities, equity, revenues, and expenses. And we'll look at how we record transactions using the accounting equation. And then finally, we are going to look at financial statements such as the income statement, statement of retained earnings, the balance sheet, and the statement of cash flows. So first, let's talk about the different forms of businesses. What we have is a sole proprietorship, which is a one-man operation where the owner and manager is one individual. Next, we have a partnership where we have two or more individuals who get together to do business and are called partners. And then we have a corporation, which is a separate legal entity made up of several different owners who are called shareholders. In this course, we are mainly going to be focusing on the corporate form of business. These forms of businesses can be either set up to do a service business, a merchandising business, or a manufacturing business. A service business is a business that provides services to a customer for a fee. Examples of a service business are your electrician's business, your doctor's office, an attorney's office, an accountant's office, and also other businesses such as Delta Airlines, Walt Disney, which provide services to their customers and charge them a fee. A merchandising business, on the other hand, sells products that are already ready for sale. Merchandising businesses are your retailers. And examples of a merchandising business are Walmart, Target, Toys R Us, Best Buy. All these provide products to customers, but they are already made. The merchandising business does not make the product that they are selling. Finally, a manufacturing business sells products that they have made or have manufactured. Examples of a manufacturing business are Sony, Apple Computers, Nike, General Motors. All these businesses manufacture the product that they are selling. Now we are going to be looking at a corporate form of business. And I told you earlier that a corporation is a separate legal entity, and the owners of a corporation are called shareholders or stockholders. And the way a corporation raises money is by issuing shares of stock. Investors who buy the shares of stock are called the stockholders or the shareholders, and if the corporation issues just one class of stock, it is referred to as common stock. So in this course, we are going to be looking at the corporate form of business, initially set up as a service business, and then chapter 4 and 5, we look at a merchandising business. We are not going to be talking about the accounting for a manufacturing business in this course. What you see here is the top 10 corporations as published by Fortune 500, the magazine. And this is a list as of May 2011. So you see how we have the top 10 companies ranked based upon their revenues. So Walmart has the highest revenue and hence is considered the number one ranked company, even though it doesn't have the highest profits. So the Fortune 500 top 10 corporations list is based on revenues and not profits. So a little bit later on, we are going to look at the differences between revenues and profits. In 2012, you will notice that for the very first time in several years, ExxonMobil took over as the number one company and Walmart took over as the number two company. So you see that ExxonMobil's revenues are now higher than Walmart's revenues. And the profits are much, much higher as well. And you will also notice that in this mix, a lot of oil companies have become part of the top 10 companies. Moving on, we're going to talk about accounting and business. Why are we talking about businesses when this is supposed to be an accounting class? The reason being that accounting is considered to be the language of a business. This is the way a business communicates, through the means of accounting. And that is the main reason why you are required to take an accounting class, even though you may not be planning on becoming an accounting major. If you are going to work for a business, you got to know the language that the business speaks, the language through which the business communicates. And so some amount of exposure to accounting is very, very important for a business student. So in this next slide, you will see, a definition of accounting, and it really tells us what we do in accounting. So accounting is considered to be an information system that, first of all, identifies events that need to be recorded and then records those events. Once those events are recorded, that information is processed and then communicated to users to help them make better decisions. Keeping in mind that the information that is communicated follows the three criteria of being relevant, reliable, and comparable. So who are these users whom we need to provide this accounting information to? These users can be grouped into one of two categories: external and internal. External users are users outside of the business organization who are in need of information about the business. So we have lenders who have loaned money to the company and want to ensure that they will get their money back. We have the shareholders or the owners of the corporation who are interested in knowing how well the company that they have ownership in is doing. And then we have the government, customers, consumer groups, and external auditors. Internal users, on the other hand, also need information and to help them make better planning and operating decisions. So what we have is managers, CEOs, sales staff, all of them are in need of information. And they get that information through accounting reports. So there are two types of accounting. And accounting can be broken down based on what information is being provided. So we have financial accounting and we have managerial accounting. Financial accounting's primary purpose is to provide information to the external users via financial reports or financial statements. So the purpose of financial accounting is to feed the information needs of external users. Managerial accounting, on the other hand, provides information to the company's internal management, and the reports that are generated through managerial accounting are not available to external users. However, reports that are generated via financial accounting are available to both external as well as internal users. Next, we're going to talk about a very important concept called GAAP. GAAP stands for Generally Accepted Accounting Principles. And what GAAP does is GAAP sets out certain criteria with respect to the information that is generated. Financial accounting is governed by some rules and concepts, and these rules and concepts are referred to as generally accepted accounting principles. So now the words tell you that this is not mandatory. They are generally accepted, and businesses are expected to follow these rules and concepts. And if they do not follow these rules and concepts, they have to be able to provide some type of a reasoning for why they are not following these rules and concepts, why they have departed from GAAP. So why are these rules and concepts necessary? Why is GAAP necessary? First of all, to meet the three important criteria with respect to the information. The information should be relevant, such that it makes an impact on a user's decision. Secondly, the information should be reliable. The information should be such that it can be trusted by users. And thirdly, and very importantly, the information should be comparable. So what we have is, if we have each business providing their information using their own sets of rules and concepts, how could you compare one business with another business? It would be very difficult to compare two businesses which generated their financial reports using different rules and concepts. So we want to have a common ground where you can compare two companies because they have presented their reports using the same guidelines. And so we want to have information that is comparable not only across different companies, but also within the same company across different periods of time. And so in order for the information to meet these three important criteria, we have generally accepted accounting principles. So who develops these generally accepted accounting principles? Well, the organization responsible for GAAP is the SEC. But the SEC does not develop GAAP. The Securities and Exchange Commission, or the SEC, is a government agency that has the authority to enforce reporting requirements on companies, and it expects those companies to follow GAAP. So all companies that issue shares of stock and whose shares of stock trade on a stock exchange are required to be registered with the SEC. And the SEC develops these reporting requirements from these companies. But the SEC expects that these companies follow GAAP. And GAAP is not developed by the SEC. The SEC delegates that responsibility to another organization called the Financial Accounting Standards Board, or the FASB. Now, while the SEC is a government agency, the FASB is a private organization made up of individuals from the accounting profession, CEOs of large companies, and the FASB is the private group that is responsible for developing GAAP. The counterpart to the FASB internationally is the International Accounting Standards Board, or the IASB. And the IASB is currently very busy in developing international common standards which are called IFRS, or International Financial Reporting Standards. And so the goal of the IASB is to develop the counterpart of GAAP globally so that information across different companies across the world is comparable and is prepared using the same guidelines, same rules and concepts. So very soon, the United States will also be moving towards IFRS, which is the common standard for different countries. It has not yet currently adopted the International Financial Reporting Standards. Next thing I want to kind of introduce you to is the Sarbanes-Oxley Act of 2002. This act was passed by Congress in response to a number of scandals across different companies such as Enron and WorldCom. And the goal of this act is to, make sure that companies do not abuse the trust that the public has placed in them. Shares of stock are issued by these companies to the public, and so the public has investments in these companies. And, with the financial abuses, a lot of investors lost large amounts of money. And so the goal of the Sarbanes-Oxley Act is to curb these financial abuses by companies by requiring these companies to have a very strong internal control structure. In Chapter 6, we will be looking at internal controls. And the goal of the Sarbanes-Oxley Act, or SOX for short, is to make the reporting of these companies transparent, more accountable, and more truthful. So next we're going to talk about the principles and assumptions of accounting. First, let's discuss the principles. Okay, we are actually going to be encountering these principles throughout the course, some immediately, some later on. So let's discuss these principles first that accounting is really based on. The first one is the measurement principle, or the cost principle. And what the cost principle tells us is that all accounting information should be based on actual cost. So all information that gets recorded should be based on the actual purchase price. It's not based on market price. It's not based on what we perceive as the value of it to be, but based on actual cost. The next one is the revenue recognition principle, which gives us guidance on when we should record revenues. And we are going to really be discussing this in depth in chapter 3. The matching principle gives us guidance on when we should record expenses. And the rule here is that the expenses should follow the revenues, meaning we record the expenses in the same period of time when those expenses helped us generate revenues. The full disclosure principle tells us that we should provide all information to users if that information is going to have an impact in their decision-making process. The next thing that we are going to talk about is the assumptions of accounting, the assumptions that accounting is based on. So once again, all items that get recorded are based on certain assumptions. And one of those assumptions is the going concern assumption. And the going concern assumption tells us that we record events as if the business will continue operating and will not be shut down. So with that assumption, we record transactions. The monetary unit assumption tells us that transactions are recorded using money as a denominator. So all items are expressed in the United States using the US dollar. Other countries will use their local currency. So for example, in Mexico, we will use the peso. The time period assumption tells us that a life of a business can be divided into distinct time periods. And so we record or report about those distinct time periods at a time, such as a month, a year, 6 months, etc. The business entity assumption assumes that we keep the affairs of the business separate from the owner as well as other entities. So we do not intermingle the accounts or the information of the owner with the business.